Hello, everyone. Good evening. After all the suspense and excitement and waiting of the presidential election is over, now we're back to accounting. Tonight, I'm going to talk about bank reconciliation statement. This is chapter 7 of the textbook, Warren Jones Tyler, 15th edition. This is primarily for my accounting 203 students, Introduction to Accounting 1 at Alabama A&M University. But it may be, as I add to all my videos, that it may be of interest to anyone interested in the topic. All right, so bank reconciliation statement is part of our internal control and cash chapter. I'm not going to talk about internal control issues in this video because I don't want to clog so many things in one presentation. So I'll specifically focus on bank reconciliation, but just wanted to let you know that this is a step. This is one of the instruments, one of the tools of internal control and one of the tools of protecting cash. All right, so why reconciliation? What happens when you open a bank account, you put some money, you make a deposit, and you start your banking. And then let's say you started your banking with $100. So you know that you have $100 and you have an account here at work, like within the company. So at the company level, there are records, which you call the home records or company's cash book. And then the bank is keeping account of your transactions. So in a sense, in an ideal world, if there was no discrepancy, if there's no dispute, then what we think our bank balance is should be the same as what the bank sends us in a statement. Of course, with every modern banking, we know that they send us a month-end statement, which we call bank statement. But nowadays, we don't actually need to wait for bank statements because we have online banking. So we can check our balance almost on real time at any point in time. But nevertheless, as a formality, as a routine work, every organization has to prepare these reconciliation statements because you need to report the true and fair amount of cash that you have on hand. And cash on hand or cash in hand, whatever you call it, is actually not just how much cash you have in your drawer or in your office. So cash includes all the checking account balances that you have with every checking and savings account balances, except term deposits, and in many cases, term deposits as well. All the term deposits would be investments. So the amount of cash means the accessible cash or usable cash, which we call, in some settings, we call it operating cash. So the operating cash or cash on hand that we have includes cash in our pockets, cash in the drawer, cash in the wallet, or cash in lockers, plus also cash at the bank, in our bank accounts. All right, so how do you know how much money we have lying in our bank accounts? We receive bank statements or we download online statements. And from those statements, we see that the bank says that at the end of the month or at the end of the period, any period, quarter or semester or year, usually year, at least a year, occasionally quarterly, the bank says that you have such and such amount. Let's say a bank says that I have $100 in my bank. And now if my secretary, my accountant says that we have a different amount, she might think that we have $110 or we have $200. And they both could be right. Remember this, they both could be right because they both are reporting different sets of transactions. And there may be a time lag between what the secretary, what our cash accountant or cash clerk has decided could be different because she might have thought that we have received or we have sent some deposits. That deposit may be still on the way. We call it deposit in transit. So the deposit that we just made, say on a Friday night, and then the 31st could be on Saturday or Sunday. Now that might take a while, or maybe we might have missed the cutoff point of 7 o'clock, 8 o'clock, Central or Eastern. So every country has their cutoff points, and any transaction or any amount arriving at the bank past the cutoff point would be reported on the following day, or it might take even a couple of days. So she might, as I said, she might be thinking that we made this deposit. So we opened an account with $100, and after that we made a couple of $100 deposit. say a customer gave us a check and we just deposited the check into the bank. So she might think that with $100 of initial deposit plus the $200 that we have just deposited, our total bank balance is $300. But nevertheless, your bank could still send you a statement that says you have just $100 because the bank has not yet received your check or has not yet had time to clear the check, to bring the check through the issuer's account or your customer's account, and the money may not still be available. So we call it usable fund or clear funds. In New Zealand, they used to call it clear funds. So sometimes you have these pending transactions that you can see that, yeah, there's a deposit of $200, but this available funds is only $100. So that fund may not have been cleared yet. So that's why there would be discrepancies. So that's one of the reasons. I will go over all the possibilities, all the possible reasons why we have these discrepancies between the records that we have in our home office, our company records, and the records that we have at the bank, or what you see in our bank statements. All right, so why reconciliation? I have three reasons here. You can see, number one reason is detection of frauds and errors. So we don't want our cash to be subject to fraudulent behavior, subject to fraudulent or like misappropriation. Because you remember, cash is the most vulnerable asset. Cash is a very delicate asset because cash is indistinguishable. As soon as you have the cash, as soon as you have your money on the cash, it could be yours. There's no specific features like a house, for example. It's very, very difficult to grab your house because your house has a physical location. But cash doesn't have a physical location. It's very movable property. Even electronic cash is even much more subtle. Is even more I'd say more movable. Recently we had this scandal involving my country of origin, my domestic country, my country of birth, Bangladesh, that about I think $800 million. $800 million of our central bank's reserve in US dollars were stolen, or misappropriated. The hackers, they somehow got hold of our SWIFT code and they transferred those money from our accounts, and the accounts used to be kept with Reserve Bank here, Reserve Bank in New York. So it is very, very slippery asset. That's why you need to take extra measures to protect it. And also cash has very high realizable value. If I have $10, then that's the realizable value of $10 is $10. But if I have this mug, then how much? You may have spent $7 to buy this mug, but how much can I sell it for? I might realize only $1 or $2. So I have much less incentive to steal this mug unless it's a designer mug, which it is. You can see it is a souvenir from EIU, but other than that, it's a mug. Who's going to steal it? Unless it's made of gold or silver or has gold-plated stuff. Anyway, so the point I wanted to make is that cash is a very attractive proposition to steal. Cash is subject to the most vulnerable asset. Vulnerable to what? Vulnerable to misappropriation, to embezzlement, like being stolen or mishandled. So therefore, we need to take extra measures to protect our cash. So we'd like to protect cash. We'd like to detect fraud, and also we like our reporting to be true and fair. True and fair. So true and fair is an essential, and it doesn't have to be accurate. We say true. It has to be true and fair. Now, if your records show that you have $300 of deposit, but if the bank statement says you have a $100 deposit, now you could make reference to either, but I can tell you, unless you have a reconciled adjusted balance, your balance sheet would not agree. Your balance sheet wouldn't balance because both the numbers cannot be right. So we need to get to an agreement as to what is the truth. So in our case, I think $300 would be the truth because our clerk has already sent the $200 deposit. So 200 plus $100 of original deposit makes it $300, but she has to simply do a reconciliation. She has to say that, look, the bank balance according to bank statement is $100 plus this deposit in transit. So that makes it $300. And our cash according to our records is also $300. All right, so these are the three reasons why we need to do a reconciliation statement for every, and reconciliation statement is not just one statement. You have to do one for every account that you have. And large organizations, you can imagine how many bank accounts they have. Even you as a student, how many bank accounts do you have? So you could have several bank accounts, and you need to do a reconciliation for each of those accounts. All right, now here is a list of all the possible reasons why our bank balance or cash balance according to our records would be at variance or could be at variance with the balance as per bank statement. Long list of reasons. So the first one is deposit in transit. Deposit in transit means money that's on its way to the bank. So our home records would have already recorded it as a deposit, but bank has not done it yet. Either they have not received the deposits yet. It may be in the, like it may have reached the bank after hours. So the cutoff time is gone. So they would have, even if it is cash, it doesn't have to be a check. Even if it is cash. So the cash that you have deposited physically, or going to a logbox or one of the deposit boxes, you may have done it at night. So the bank statement was already printed at 7 o'clock in the evening or 8 o'clock in the evening. So the bank statement at the end of the day would not show it. But your office, you might have actually made the deposit or left office at 4 o'clock or 4:30. So your secretary has recorded it as a deposit. So it's between your office and the bank. It's somewhere in between. So that's what we call deposit in transit. It will eventually be reported as a deposit. So your deposit will go up, but the problem is timing. And in the middle, there was this accounting period end, quarter end or month end. Had there been no accounting period end, it would not be a problem, because sooner or later, your deposit, if it is cash or if it's clear fund from your clients, it would be readily available. It would be ready for use. It would be included in your balance, included in your deposits, in your bank balance. All right, so deposit in transit is our number one reason. Second is outstanding checks. Outstanding checks are the ones, means checks written, checks issued, but not presented. So checks issued means checks that we gave to our, say, employees or to our parties, different parties, maybe suppliers. We give them checks. We make payments to our plumbers, to our employees, to our say, landlords. We make payments to everybody. Now, all these checks, there's no guarantee that all these checks would be presented by those recipients, by the beneficiaries of those checks, to their corresponding bank accounts, respective bank accounts. What's the guarantee? Some people are too rich, they couldn't care less. Some people could be busy, some people could be lazy. So for a whole, and some people might have lost it. They might have kept it in their lockers and then forgot about it. So for a whole host of reasons, checks issued may not have been presented before the period ends. But our secretary, what did she do? She would have written each one of them as a payment. So as I pay rent, money goes down, my bank balance goes down. So she records it as a payment. So my rent, my plumbers, my telephone bills, my all sorts of payments. If I have employees, I mean, think it like a business. So then I would have employees, I would have workers that have paid a lot of people via checks, especially suppliers, my vendors. All right. So these payments could still be pending. Well, I mean, we made the payments, so we are clear, but they may not have taken the money out of our bank accounts. So these are called outstanding checks. Means checks that are floating around in the town, but have not hit our bank, which is a good thing for us, because we don't, we don't want our bank balance to be. I mean, the more money you have in our bank, the better. Some banks pay interest on your deposits on a daily basis. Well, in the US, the interest on checking account balances is almost non-existent. So in terms of earning an interest, there's not much incentive. But in terms of having some liquidity, you don't want to miss your covenants. So that's in a sense better, that I don't want any of my parties to encash any of the checks that I give them, because I have the best of both worlds. On the one hand, I could claim that I made the payments, I have already paid you, But on the other hand, I have not paid them because they have not taken the money out of my bank account. Anyway, so that's just joking. What is important for us is that there will always be this timing difference. You write a check on the 29th, and the parties might not have had time, but they may have actually put it in the bank, and their bank would have sent it to your bank, and then there's a clearing process, clearing house that we all know. So because of all these reasons, this check or these checks have not yet hit the bank. All right, so money has not gone out of our accounts. So that's outstanding checks. Number 3 is all the credit memos. Credit memos are like direct deposits, like my salary comes into my bank account as a direct deposit. So there would be a lot of direct deposits. We don't know, like Walmart or IBM or large companies do not, it is impossible to keep track of how many direct deposits, how many money come in to your bank account, how many people pay us, like purchase our goods. Think of Amazon, So Amazon's home office, it's impossible to ever know how much money is coming in as credit memos, directly into their bank account. So a lot of customers, they pay through PayPal or other gateways. They pay into our bank accounts. All right, so these are credit memos, generally direct deposits, and any other collection that the bank is making on our behalf. Banks do an agency job. Banks could collect your rent. Banks could collect your taxes. Like IRS, could have a bank to collect, to receive. Universities, schools, colleges, they have banks to collect their fees. So guardians, parents, they go to a bank account, a bank counter. They don't go to the school to pay kids' tuitions. They go to the bank. Now, electricity companies like Huntsville Utilities or power companies in our country or in every country, they have their customers to go to a particular bank, and pay the bills. So these are all credit memos. So our secretary would not have any clue as to how much money would have come in through those gateways. All right, so these are credit memos, and then we have debit memos. Debit memos are like direct payments. You wouldn't remember how many places you authorize, how many people you authorize to take money out of your bank account. So your mortgage is one. You may have a lot of direct debits or direct payments. Like your credit cards could have direct debits, automatic payments that we call automatic payments before the due date, so that you don't miss a payment. So your Netflix, your phone bill, your power bill, your internet bill, your insurance, health insurance, life insurance, car insurance, all sorts of payments. You have a lot of direct debits. So those parties would have taken the money out of your bank account at their convenience. They have the prerogative, you authorized them, but our secretary would not have a clue as to how many. Even if she does have a clue, it's impossible, almost impossible to know all the ones, to keep track of all the ones. So for these we actually wait until we receive a statement. Then we find, okay, yeah, all these direct debits, yeah, so money has gone out, so let us rather update our records. So with credit memos and direct memos, it is customary for us to wait until we receive the bank statements. And when the bank statement comes, it comes with all those whole like bundle of memos. Some are credit memos, usually in one color, and some are debit memos, usually in a different color. So banking made easy. All right, so you have direct deposits and now direct debits, and also bank fees go automatically, bank charges. Banks make money out of everything. So you left $100, and if you don't do anything, after a couple of months, just check, your $100 will be gone, and your account could be in debit just for monthly fees and charges and whatnot. And sometimes you'd find that at some point after a couple of months, you may not have spent a single dollar of that $100. The bank would take the courtesy of taking the money out of your account to meet their requirements. They wouldn't do it illegally. They will have you authorize them to take money out for a whole host of reasons, and they would do that as they please. And then at some point your account would be in debit, and then they would take the privilege of actually canceling your account. And then you go next time, they'll say, well, we have a bad record. You cannot even open an account with us, or please, you owe us $35. So if you could kindly make that payment, then we'll be able to not not sometimes it could be too late that they wouldn't even be able to revitalize or reopen that account. So that account would be dead. And if you're lucky, then you'd be able to open a new account, but you'd have to make those payments first. So bank charges is an Achilles heel. It is a pain, but this is a pain that we have to endure if we have to receive the services of these wonderful institutions. So we have those as part of those direct debits. And then we have errors. Errors could be made by the company staff or the bank. Either party could make those errors. I'll talk about the errors in a moment. And my final point is NSF checks. NSF checks are like not sufficient fund checks. So NSF means the checks that people gave you. Like one of my students say, they paid me as part of the tuition. Let's say I privately teach them one-on-one, and you paid me $10. You paid me a check. You gave me a check worth $10, and then I'd take that check to my bank account and I deposit it. And then my bank would actually go and contact your bank and would bring the $10. But what if when my bank contacted your bank and found out that there is not sufficient funds, if your bank declines that check, it depends on your arrangement with them, even if you don't have any money there. If you have arrangements, depending on your relationship with them or your account status, they could honor it, they could not honor it. But I'm assuming, let's say they did not, or they do not honor it. If they do not, then it would be treated as an NSF check. NSF checks would be a problem because we at our office, we thought that this money has increased our bank balance. This money has gone into our bank account, but now turns out that this money has not. So we'll have to get that bank balance down. All right, now errors are like this. Let's say you made a payment of $19, $19. And your secretary could transpose the two numbers. She could write it as 91. 19 becomes 91. So your bank balance would be unduly suppressed, isn't it? Because you spent $19, she recorded it as $91. Or vice versa. You made a payment for $91, but by mistake, she wrote it as if it was a $19 payment. Then the bank could do the same. You made a payment of $19, the bank could have recorded it as 91, although it's very unlikely. Now banks are very efficient. I've not seen banks do these silly mistakes, but I've seen banks do other mistakes, and mistakes to err is human. So it is possible for any of us to make those mistakes. And that's why we are for, that's why the accountants, you guys are being trained to solve these problems. All right, so the payment that the payment of $19 that a customer made, the bank has recorded it as $91. That means the bank has unduly suppressed your account. Your bank balance, your account balance would show a smaller amount because your payment was 19, but she recorded it, or he recorded it as $91. And vice versa, it could have been a deposit that you made a deposit of $91, but they recorded it as 19, or vice versa. I'll say 910 could be 190. There would be all sorts of errors. It's a matter of which number, which keyboard, what button of the keyboard you press. So many of these are done manually, still manually. Like when you write checks and go to a bank counter, they enter the amounts manually. Sometimes there are scanners. So if there are scanners, then scanners do not, scanners are there to take a snapshot, to make a PDF, to take a picture of the check, and to have records of it, that this was the amount, this was your signature, this was the date, and this was the beneficiary of the check. But the amount, the scanners cannot, because these are handwritten numbers, the scanners are not gonna figure out what number was written there and then punch it. So it has to be entered manually. So whenever man behind the machine is involved, men, what men do, men and women, so we make those mistakes. We punch different buttons. Anyway, so errors would lead to 4 things: understatement of deposits or overstatement of deposits, and understatement of withdrawals, and overstatement of withdrawals. And for all 4 must be accommodated through those errors. So I have made in my procedure, I have accommodated all 4 of these. Like if the bank understates a deposit or overstates one, or understates an withdrawal or overstates one. So there will be 4 items on the bank side and same 4 on the company side. Like if the company secretary understates a deposit or overstates, or understates an withdrawal or overstates. So remember that 4 and 4, you'll see a total of 8 possible errors. Okay, 4 errors, but 4 errors could be committed by the bank, or 4 errors could be committed by the company. So that makes it 8. All right. So there's the list again. You can see these are the possibilities why we need to reconcile deposit in transit, outstanding checks, credit memos, debit memos, errors, and NSF checks. All right. Perfect. Well, and now the procedure, reconciliation procedure. So this is going to be your Bible. This is a template that I hope you will find very, very useful. Well, so make a 2-column, make a T here. One is the bank section, another the company section. Bank section starts with balance per bank statement. Company section starts with balance per the company records, balance per cash book. All right. So let's focus on the bank section first. We start with the balance per bank statement and then add, the first one we add is deposit in transit, because this is on the way. It's just a matter of time when it hits the bank account. So as soon as it arrives there, chances are that it will be a clear fund and it would boost our account balance. So you start with your balance per bank statement, then add deposit in transit and subtract outstanding checks, all the outstanding checks, subtracted. Checks issued but not presented for collection. Checks issued by the company but not presented by the client or clients. All right. So what else is there? We have dealt with deposit in transit and outstanding checks. Now you can see here understatement of deposits. So any error made by the bank, these would be errors must have been committed by the bank clerk, the banker. So any error committed by the bank would be accommodated here, would be dealt with here. So the first one is understatement of a deposit. So we add it. It makes perfect sense. If you have done something that understates my deposit, I have to add it, because deposits understated means my bank balance is understated. So we just need to put it back in so that it's not overstated, it's properly stated. All right. So understatement of deposits must be added, and that means overstatement of withdrawals must also be added. Or put it this way, if understatement of a deposit is to be added, then understatement of overstatement of a deposit must be subtracted, isn't it? Still the bank section. I repeat, we said an understatement of a deposit must be added. So understatement of deposit is added, that means overstatement of deposit has to be subtracted. That makes perfect sense. And also logically, if understatement of a deposit has to be added, then overstatement of a withdrawal must also be added, because they're the same thing, they have the same effect. Understatement of a deposit is added, that means the opposite would apply to withdrawals, isn't it? Understatement of deposit, what does it do? It suppresses my bank balance, and overstatement of withdrawal also does the same, doesn't it? If I withdrawn, say I withdrawn say $100, and you have recorded it as $1,000. So overstatement of a withdrawal, that means my balance would be suppressed by $900. So you have to put that $900 back in. All right. So see again, in the bank section, you add any understatement of deposits or overstatement of withdrawals, and then go quickly to the second slide. Here, just the opposite. Here, any overstatement of deposit must be reduced, must be subtracted, and hence understatement of withdrawals must also be subtracted. See, overstatement of deposit means you have overstated a deposit, so the bank balance is unduly overstated. Now slash it down. So overstatement of a deposit must be subtracted. I said minus to make it easier, and hence understatement of an withdrawal must also be understatement of withdrawal must also be subtracted. So these two are subtracted. So not a lot, not a lot. In the bank section, you have deposit in transit, outstanding checks, and then understatement of deposit and overstatement of withdrawals are added, and their opposites, their mirror image would be subtracted. Images. All right, now the company section. The company section is actually a little more lengthy. It's not more complicated. It just has more items in it. All right, so let's start with balance per cash book or balance per company records here. So we start with this, and then we add credit memos. Excuse me. We add all the credit memos, any direct deposit that you don't know. Credit memos would come as surprises. Some are pleasant surprises, some are not so. So if you have received those credit memos that you do not know, then add them to the balances, to your balance. So one is a direct deposit, collection of a note by your bank on your behalf, collection of notes, any fees, and other receipts by the bank on your behalf. So banks could be collecting, as I said, my electricity bills. If I'm an electricity company, it would collect my revenue. It would collect my sales. My customers would be making payments. So as soon as I receive the advice, I would add it to the balance that I have in my home office records. All right, so direct deposit, collection of notes, fees, and other items, other receipts by bank. And then the opposite, the same ones. And this is I made it. You could say it's my template, Kareem template of a bank reconciliation statement. You wouldn't find one similar to this, or you wouldn't find an exact one anywhere, and which is so exhaustive. I would say exhaustive because I have accommodated any possible errors. Bank error, your clerical errors, anyone does it, and in any direction. You just have to find out what was the effect, what was the implication of the error. Has it understated a deposit, or has it overstated it? Has it understated an withdrawal, or has it overstated it? And then you fit in here. All right, so we report the same ones, and here the beauty is that the same language. So here you can see understatement of deposit and overstatement of withdrawal. You're going to see the same understatement of deposit and overstatement of withdrawal. Why? Well, the same treatment on both the banks section as well as on the company section. But remember, we don't report the same thing on both sides. Then we are not helping reconcile. But we would, I say, it's the same language, but the error must be committed. The error could not have been committed by both the parties on the same check or on the same payment. So the errors, this is although the same language, but on the bank section, we deal with errors committed by the bank, by bank employees. Here we deal with errors committed by our company staff. But if the implication is the same, if our secretary has made an error that has understated a deposit, so we add it, or overstated a withdrawal, we add it, and vice versa, we subtract. Like overstatement of a deposit and understatement of a withdrawal would be subtracted. All right, so closely look at it again. You start with balance per company records, balance per cash book, and then plus credit memos, direct deposits, collection by your bank, and then understatement. Remember, understatement of deposits and overstatement of withdrawals, and interest on any deposits. So bank, if the bank is so generous, if they award us with any interest, then that's a good news. That would already be reflected in our bank statement. So we just have to make the correction or the adjustment in the company section. And then look at the second slide. You can see the bank section is almost empty, but the company section is full. Then you have those direct debits. We have the payments made by our bank on our behalf that we don't know, that we just found out from the debit memos. So this is all the debit memos, including the direct payments, like payments of notes, notes payable, payments of bills, payments of any of our expenses, like our salaries, wages, rent, any payment that the bank was doing on our behalf. So those payments would now have to be recorded in our company records. And then, of course, one common one is bank charges and fees. If the bank, as they please, as I said before, that they would charge fees and you know, all sorts of charges. So we are going to find out only when we receive the statement how much of what they have done. Then we update our records. So bank fees, bank charges, bank interests, and there'll be interest on any overdrawn or any penalties that they imposed. And NSF checks. NSF checks is a deduction, is a subtraction from the company record. There's nothing you have to do on the bank records because it's NSF, the bank would not have done anything. Bank would not have recorded it as a deposit in the first place. So there's no correction there. But you, the company, will have done it. The company might have done it as a receipt because they didn't know that it would be NSF. They thought it's a clean check. It would be a good, or it would be a clear fund. There would be clear fund for you to expect the check to be honored and for the money to be into your bank account. All right, so NSF check has to be subtracted, and then the overstatement of deposits and understatement of withdrawals. Overstatement of deposit means you have done some mistake that has overstated your deposit, so you don't want one overstatement or understatement of anything. So if you have overstated, if you have done something that has led to an overstatement of a deposit or of deposits, then slash it. And same for understatement of withdrawals, because you withdraw say $100. If you have written it as $10, then now it's time to reduce your bank balance by the remaining $90. All right, so that would end it. Once you have made changes, all these, or adjusted all these, check again, pause and read. And then here, so that would be your adjusted balance. And this adjusted balance, this third number, there would be one number, bank statement, bank balance as per bank statement. There would be a second number, bank balance as per company records. And a third number would be this adjusted balance. So this adjusted balance is the real balance that we'll be reporting on our balance sheet. So that would go to the balance sheet. Now I have solved one problem here from the textbook as a demonstration. This is one of the problems in the problem series. It's problem 7-4B on page number 390 of Warren Jones Tyler textbook. So page number 390 says that we have such and such amount according to our bank statement. So you can see balance by bank statement here. That's at the end of November. And this problem is interesting because of, see what? It doesn't give you the balances on the same day, on the same date. So the bank statement shows balance at the end of the month, while the cash book shows balance at the beginning of the month. So you don't see all problems to start like this. You would usually see, say, the bank statement, the balance per bank statement at the end of January or at the end of December is such and such amount, and bank balance per our records on the same date, same time, is a different amount. But so I like this problem because of this one of the this one feature. So we have balance per bank statement, this amount, but see balance per bank company records or balance per cash book. I'm sorry, it's not focusing right. Yeah, so balance per cash book, different amount, but on 1st of November. What's this? This is 1st of November, and this was end of November. And then they said, with that 1st of November balance, we made all these deposits throughout the month and made all these withdrawals. So you start at the beginning of November balance and then add all the deposits and subtract all the withdrawals. And then you will have a balance that would be on the same date or at par. So now time-wise, this is what we need to reconcile against this, not this. So these two are not our subject of reconciliation. These two are. So your balance per bank statement is this number, and balance per cash book is this number, not this number. And then we have done the adjustments, simple ones. Here we have deposit in transit, we added. Here we have outstanding checks, we subtracted. And there's an understatement of an withdrawal. So understatement of withdrawal means withdrawal understated means the bank balance has not been down enough. You know, like an withdrawal was say $500 and you've shown it as a $50 withdrawal. So the bank balance would be too much. So take it out. So understatement of an withdrawal is adjusted here for. Adjusted for here is a subtraction. And on this side, we have balance per cash book. So starting number is this. And then we have overstatement of an withdrawal. That's an error, company error, but the error led to an overstatement of an withdrawal. And then we have collection of bills, collection of notes, including an interest. So remember, if there's interest with it, you have to include the full amount. So collection of notes, and then minus bank service charge and NSF check. Very simple problem. NSF check, we know service charge, you know, because service charge is something that the bank statement have already included. So it would already feature those service charges, but our records do not. So now it's time to subtract it. So take away bank charges and take away NSF check. All right, so that would give you this adjusted balance, and you can see the number, same number, the endpoint of both the columns. All right, now your bank reconciliation statement is done, but there is one unfinished business. You still have to do a little more work, and that is journal entries. So typically all problems and exercises, they want those journal entries too. Now we have seen, like in this problem, we have seen 1, 2, 3, 4, 5, 6, 7 adjustments. 7 adjustments altogether. How many journal entries would we have to do? So there is a very simple rule that you don't have to do anything. So these the changes that you have made on the bank section, any corrections, any overstatement, understatement, these are all bank's job. They will update their records, okay? Like deposit in transit and other things. We already have it. Outstanding checks, we have recorded those checks as payments. Deposit in transit, we would have already recorded it as a deposit. So nothing in the bank section needs a journal entry, remember. So you don't just ignore it as far as journal entries are concerned. Only the changes that you made here, these would need journal entries. So for example, in this case, if there are 4 items here, 4 adjustments, you'd need 4 journal entries. For example, what is our journal entry for bank charges? This is an expense. We just discovered that bank charged our account by say $15. So debit bank charges or bank fees or bank penalties or bank commission expense, debit and credit cash. So that's a journal entry because there's a transaction that you just discovered. And for NSF check, you need to do a journal entry because the guy who, because of whom your check, that check was dishonored, that guy has to be brought to account. So that means they, when they sent you the check, you cleared them of their debt, but now you have to bring them in. So they would become your accounts receivable now. So debit accounts receivable and credit cash. Simple, because they are now. So, or remember that you just flip the entry that you made when they gave you the check, when they made the payment. So what did you do when you received the check? You debited cash and credited accounts receivable. Now just do the opposite. All right. And if the bank charges you any dishonor fee, then fairly speaking, it's your customer who is supposed to be making good on that. So they would have to pay. So debit, when you debit them as accounts receivable, the accounts receivable number would be slightly higher than their original debt. So if the check was say for $300, but if you think that the bank has now charged another $35 as a dishonor fee, and I think if you cannot excuse your customer for those $35, most companies would, or you are entitled to charge your customer for that $35 as well. So you'd now do accounts receivable would be $335. Credit cash would be $300, and the other one would be a reversal of an expense, because this is an income or a reversal of an expense, because you are charged that $35 in bank fees, because in this debit, in the bank charges and commissions debit, you will have had this as an expense. So that $35. So now reverse it because you're collecting it from your customer. So this one would be accounts receivable for the NSF check. For example, say the actual check was for $3,000, but now we're going to charge them $3,035. So I would do debit accounts receivable, $3,035, credit cash, $3,000, and credit reversal of bank service charges, $35. All right. And then we have the direct deposits. So these deposits, well, not these deposits, but if there is any direct deposit, we have no direct deposit. We have overstatement of a withdrawal and then collection of a note. So the note has been collected. We have received the money. So debit cash. And if there was any interest income, debit that too. Say the note was for $7,000, but you have actually collected $7,300. So debit cash was $7,300. Credit notes receivable, $7,000, and credit interest income for the remaining $300. So that's how you do these journal entries. So collection of note, and then how do you do this overstatement of withdrawal? You debit cash because you thought you took too much money. Now put the money back in. So debit cash and credit the withdrawal. Debit cash, credit maybe a party who you give the money, or you thought you gave the money, you didn't give them. The party actually received the money that you owed them, but your secretary has recorded it as if you paid them too much. Or say rent, say you paid your rent. So you thought rent expense debit, credit cash, maybe your rent was $700, but you recorded it as $7,000. So now put the money back in to your cash. So debit cash and credit rent expense reversed, or reversal of rent expense, because rent expense was actually $700 that you recorded as $7,000. So the remaining $6,300 would now be credited. So expense would come back to its original place of $700. All right. So what we learned? We learned that as far as journal entries are concerned, our focus, not just main focus, our only focus would be the companies section. And every change, every adjustment that you make here would merit a journal entry. So there would be one for bank charges and fees, one for NSF checks, one for any direct collection, any direct payment that you didn't know, you just figured out. So these and any errors from leading to understatement or overstatement of deposits or withdrawals. All right. So I hope you enjoyed it, and I hope you benefit from these discussions. And please, use this template. Use this template, this one, and this. This template is absolutely exhaustive. There's nothing that you cannot fit in here, because those 4 plus 4, 8, those understatement of deposits by the bank or by our client, and opposite, overstatement of deposit, and then understatement of withdrawal, and its opposite, made by either the bank or by us. So that takes care of all the errors, all the possible errors. And then NSF checks, bank charges, what else? Deposit in transit, outstanding checks, direct collection, direct deposit. So you just have to delve in. You have to live in there for a couple of days, focus on a chapter, practice one after another, practice several problems, and then you'd be on the driving seat. All right. So thank you so much for listening. Thanks for your patience. Have a good evening. Good night. Bye-bye.